The government is shut down, which means we didn't get the BLS jobs report last week. So we're flying blind here on Monday, but we're going to do our best. And actually, this government shutdown is directly slowing down the housing market by delaying an extra 1,400 homes from closing daily right now. 1,400 a day. I'll explain how in a minute. We had a huge jump in closings this week here in Dallas and Collin counties. National housing inventory did see a small increase, though we're still losing ground compared to a year ago, and we're now below 18% more inventory than we had last year. Whereas just a few months ago, we were as high as 33% more inventory than last year. New listings, however, are still growing a little better than the previous 3 years. We're still consistently getting more pending contracts than any of the previous years. And if the government shutdown remains through this week, we're not going to get the inflation reports that are due, and you're going to have to listen to me make stuff up out of the air again next week. We're covering all this and much more in this week's market update. My name is Michael. I'm a real estate agent here in the Dallas-Fort Worth area, and every Monday I give you a weekly update covering all of Dallas and Collin counties as well as the national market. We're looking for trends. We're tracking mortgage rates as well as mortgage purchase applications, as that's our best leading indicator to what demand will look like 30 to 90 days from now. We're looking at things like median list price, days on market, how many homes are having price decreases, what's inventory looking like, and if you stick around until the end, it's my favorite part, the top 10 ranked hottest and coolest cities and zip codes in all of Dallas and Collin counties. If this sounds like something you're into, make sure and hit the subscribe button. And if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, I've helped every one of these yellow dots find their little piece of Texas, and I'd love to help you too. Just call, text, or shoot me an email. All that is in the description below. Okay, today is October 6th. Let's see what the data is telling us this week. And if this is an old video, you can click the playlist here to get to the latest weekly market update. Okay, starting with market news. The federal government shutdown has suspended the National Flood Insurance Program, putting thousands of real estate transactions at risk. Basically, if your home is in a flood-prone area, your lender will require you to have flood insurance to protect their investment. So if you suddenly are no longer able to get flood insurance because the government agency that provides it is shut down, then you can't close on your house. And right now it's delaying an estimated 1,400 home sales per day across more than 22,000 communities. The National Association of Realtors reports that the NFIP supports roughly 500,000 home sales annually, generates 1 million jobs, and $70 billion for the US economy. Obviously, this isn't as big of a deal for us directly here in Dallas because we don't have a lot of flood-prone areas, but it could have a really big impact on how the overall housing market is seen. A lot of people who report on the housing market are going to be saying the market is crashing, sales are crashing, and it's just because they don't understand or know that people literally can't close. So while it most directly affects areas like Florida, it also indirectly affects the rest of the housing market if the media descends into panic over nothing. It takes a lot to undo those scary sound bites in people's minds. So just know, if this shutdown continues and you start to hear about canceled closings and home sales dropping, there's a good chance it's because anyone buying a home in a flood-prone area literally cannot close at this point. And as of last week, Florida had an estimated 28,149 homes pending and another 97,273 active listings. So when you hear we have about 864,000 homes available for sale in the country, and 97,000 of those are located in a state where they can't close until the government opens up, you can see the problem. And Florida's not the only area with flood exposure, it's just the biggest. This is going to affect other states as well. So just be aware, if you start seeing a lot of those YouTube thumbnails where the people do the really shocked face and they got the flames going on in the background, maybe some explosions, if they're talking about canceled transactions and dropping home sales, probably just flood insurance. Okay, moving on. Because of the shutdown, we also have no jobs data. We did not get the BLS jobs report, which is the main thing we cover the first week of the month. So let's just go over what we do know. First of all, the Fed is not nearly as worried about the soft jobs reports as I am. Jerome Powell recently stated on live television that job growth of 0 to 50,000 is now acceptable. Even though last year we were averaging more than 150,000 new jobs every month. Suddenly 0 to 50,000 is plenty. And what they're trying to say is population growth has slowed, largely due to less immigration, and the proof they have of this is that even with these smaller jobs growth numbers, unemployment is still only at 4.3%. So that must mean less people are looking for work. They're saying if this slowdown in new jobs were truly a crash in the labor market, unemployment would be much higher, which has to be true to some degree. So that's what they're saying. Here are some charts that I care about. Chart number 1 is the residential building construction chart. This is the number of workers that are employed building new construction. And as I've shown many times, you'll see when there are mass layoffs that happen specifically in the residential new construction, it's usually a sign that a greater job loss recession is coming. You can see it here. Layoffs in construction, recession. Layoffs in construction, recession. These gray areas are the recessions. Layoffs in construction, big recession, and then there was a little one here during COVID, but that one is different. And although the new construction housing market has been slowing with these higher rates, you can see there haven't been any significant layoffs so far. And the recent drops in rates are surely going to help delay this, and hopefully the pace at which rates do drop moving forward will be able to support this many workers and keep new homes being built, because more inventory is a good thing for Americans, and avoiding mass layoffs is also a good thing for Americans. Chart number 2, jobless claims are softer, but still nowhere near breaking. We don't need to be worried about a job loss recession until these initial jobless claims, this is the 4-week moving average, and until this moving average gets well above 300,000, probably more like 325,000, then we don't really have to be concerned. And so far right now, we're only at 237,500, which sure, it looks close to the top of this range over the last year, but again, it's nowhere near the danger zone. So again, just more evidence, things are softening, but they're not breaking, and they're not actually even that close to breaking. Continued claims, however, have hit a 3-year high up here. I mean, we've been high for a while, which just tells you it's harder to find work if you are unemployed. But personally, I don't think this chart means much to the Fed, at least not nearly as much as the initial jobless claims, which again are still low, as well as overall unemployment being only at 4.3%, which is also historically low. So what I expect from this jobs report when it finally comes out is probably just more of the same. The labor market is getting softer, and its shrinking is likely due to slowing population growth, but unemployment is not out of control, and we're not seeing a huge surge in jobless claims. So it's still not breaking. So just more softening without breaking. Also, current GDP growth for this quarter is still over 3%, and stock prices are near all-time highs. And the consumption part of GDP, which the Fed cares about, is still strong. People are still purchasing goods and services, so the economy is still expanding, and there is nothing for anyone to panic about at this point. Okay, that's enough of that. I don't have a property showcase for this week. This last weekend was actually my son's birthday, so I was booked up the whole weekend. So we're just gonna move right along, starting with national housing inventory. This week we had an increase, a small one again, of 1,397 more homes for sale in the country, which is more or less just flat for the last 4 weeks or so. All of this is pretty flat. We're still slightly below our peak for the year. No idea if we're going to get above that or not, but as I've said many times, it's unusual that we would have peaked this far back. Even if we slightly peak over, this whole flat part is still unusual. You can see we should be going up until October, November. You see it in this year and this year. These are all the previous 3 years. So this is certainly a departure from the previous 3 years. But even though we saw a small increase, this actually drops us another 0.44% to just 17.66% more homes available than we had last year. And if you'll remember, just a few months ago, we got as high as 33% more inventory than last year, and now we're under 18%. But overall, we have 863,972 homes available for sale in the country, and this same week last year down here, we only had 734,257, so still way better than last year. Way down here at the bottom, we only had 240,000 homes for sale in 2022. The peak of last year, we had 739,000 homes, and once again today, we're at about 864,000. Now looking at new listings, this week we had 750 less new listings than we had last week, but that's still 3,205 more than we had last year, for a total of 64,328 new listings. And this is very welcome news, because as buyer demand increases from lower rates, we're going to need more listings. That's going to keep prices from going up quickly. Now moving on to weekly pending sales, which you can just think of as new single family contracts. This week, new contracts decreased by 920 from last week, but it still gives us 3,188 more homes contracting than a year ago, for a total of 64,232 new single family contracts. The last thing we cover nationally is the percentage of homes having price decreases. Every year it's normal for a third of homes to take a price cut before selling, and looking at the national chart, we had a tiny increase of 0.2%, which to me is the same as flat, which is where it's been for like the last 4 weeks. We still are nowhere near the peak, but 41.8% of homes took a price cut this week. And you can see we've been following last year's trajectory pretty closely. That's this red line right here. And so it would be normal for us to kind of start flattening out and ultimately curving down through the end of the year. So I do think we've already seen the peak. Probably going to be more sideways and a little bit down at the end of the year, probably landing between 22 and 24. But last year we got as high as 39.9, the year before 39.2, the year before that 43.2. And just so you know, if you want home prices to continue down, this number would need to continue going up. and I don't think it's going up anymore this year. Okay, moving on to mortgage rates. We started last week with a 6.38. We got as low as a 6.34, and that was Friday, but of course we didn't get the jobs report. So we don't actually have any new data to go off of, but this week we moved up a little. Just looks like normal market fluctuations. We're back up to a 6.38. So we went up 0.04 on Monday. But something worth noting is all last week we were as high as 0.18% above where we were a year ago. And now we're 0.15% below where we were a year ago. So keep that in mind as we look at mortgage purchase applications. So mortgage rates are about where they were a year ago, but you can see we still have, this week we're 16% more people applying for mortgages this week compared to last year, even though mortgage rates are about the same as they were a year ago. Isn't that interesting? And week to week, we had about a 1% decrease this week, but again, 16% year over year, even though mortgage rates are about the same. And this gives us 32 straight weeks of positive year over year growth. But I've been saying it for more than a year, and I still believe this. There's no reason to believe mortgage demand is going to grow to normal levels and with rates anywhere near this high. They're going to have to be at or below 6% for a sustained period of time. The evidence we have of that is new construction has been offering that, and they've been growing and growing in sales over the last few years. Okay, now we're moving on to the local markets, starting with the MLS data of Dallas County. And this week in Dallas County, we had 602 new listings, which is 61 more than last week. And so this is great news because you can see we were definitely declining the last 3 weeks pretty heavily. So we bounced back. 602 is a lot of new listings, and that's good news because again, more inventory means less chance of prices going up once rates drop and more demand comes into the market. We also had 370 closings, and you can see closings are going up and up every single week, but this is from data from 30 days ago. So we had 63 more closings this week compared to last week, and you can see 209, 229, 51, 07, and now 70. That's a lot of growth. Well, you can guess what was happening 4 weeks ago. You see this big drop? This was 1 month ago. You can see it was on 905, and now we're at 1006. So this just shows you how sensitive people are to mortgage rates. Just this drop coincided exactly with this huge jump in closings. So people really are that rate sensitive and paying that close of attention. And then of the homes closed, 58 were immediate sales, meaning they contracted within the first week, and that's 17 more than last week. But currently this week, we only had 269 new contracts, which is 8 more than last week. Outside of these 2 weeks is 304 and 298. 269 is pretty on par with where we've been. But in total, we have 2,025 homes either under contract or pending, and that's 110 less than last week here in Dallas County. Now moving on, same thing, but for Collin County, we had 494 new listings, which is 47 more than last week. Again, more listings is good news. We had 360 closings, same as Dallas. You can see all of this growth as rates were dropping. But 360 closings in Collin County, that's 45 more than last week. Of the homes that closed, only 27 were immediate sales, which is 9 less than last week. New contracts this week, we had 173, which is 5 more than last week. And again, outside of these two, or really just outside of this 1 week, 173 is actually still on the higher end of most of these weeks. And then in total, 1,807 homes either under contract or pending. That's 134 less than last week. Normally, I would be going over the market action index for Dallas and Collin counties, but as you can see, they have not been loading. This is how they've looked all morning, so we're gonna have to skip that today and move straight to the hottest and coolest cities and zip codes in all of Dallas and Collin counties. And these are actually ranked using that market action index number that we're not able to cover. But in short, anything at 30 or below is a buyer's market. Above that, we're asking how much of a seller's market are we in. Starting with the hottest cities, the absolute hottest remains Carrollton, Texas, once again at a 38.08. So not crazy hot. Remember, 30 or below is a buyer's market. We're only at a 38 for the absolute hottest city. Then Coppell heats up 1, Hutchins heats up 1, Grapevine heats up 3, Grand Prairie remains, and Lancaster as well remains. DeSoto cools off 5, Irving remains, Garland heats up 1, and Princeton cools off 1. So those are your hottest cities. Then we like to look at specific zip codes. You can see the hottest zip code is a 44.89, so way hotter than the hottest market on the city level. But the absolute hottest is Irving, 75061 at almost a 45. Followed by Garland, 75041, Grand Prairie, 75052, Dallas, 75249, Dallas, 75206, Duncanville, 75137, Lancaster, 75146, Carrollton, 75007, Carrollton, 75006, and Garland, 75044. So if you've got a home in one of these zip codes, you should be able to sell for top dollar. Now same thing, but looking at the coolest cities and zip codes, the absolute coolest is Whitewright, which cooled off 4 spots to get down here this week. And you can see everything except Farmersville is actually a buyer's market on the city level here. So Whitewright cools off 4, Anna, Royce City, and Prosper all remain in spots 2 through 4. Salina cools off 1, Rockwall cools off 1, Van Alstyne cools off 3. Leonard heats up 7 spots. You can see this tiny blip up. I don't even know if you can see it because I'm kind of zoomed out. Let's see if we can zoom in. You see that little blip up right there from 27 up to 29.62? That moved it up 7 spots this week. And then Nevada remains at number 9, and Farmersville jumps onto the list out of nowhere. And then Sunnyvale, which was number 8 last week, fell off the list this week, or heated up off the list. Then looking at specific zip codes, you can see all of these zip codes are buyer's market because they're all below a 30. The absolute coolest is Whitewright 75491 at a 26.88, followed by Anna 75409, Royce City 75189, Prosper 75078, Salina 75007, Rockwall 75087, Dallas 75233, Van Alstyne 75495, Leonard 75452, and Nevada 75173. As always, if you're looking to buy, sell, or invest here in the Dallas-Fort Worth area, whether it's next week or next year, I'd love to connect. Just call, text, or shoot me an email. All that is in the description below. Thank you for watching. I'll see you in the next video.